There is no change in benchmark rates, no change in policy stance, but looks like the RBI is setting the stage for an interest rate hike. Good evening, I'm Supriya Srinath. With me in Delhi is my colleague Sandeep Gurumurthy, and straight on to the big debate tonight. Unveiling the 6th bi-monthly monetary policy review, RBI Governor Urjit Patel said the MPC has decided to keep the repo rate unchanged at 6%, even as policy stance has been maintained at neutral. However, the central bank did raise the red flag on inflation and listed 6 things that could stoke up prices beyond the RBI's comfort level. First and foremost is the impact of the staggered HRA hike, followed by a pickup in global growth, which could push up crude oil prices further. At least there are 3 risk factors emanating directly from the budget, including the hike in support prices for farmers, custom duty hike, and of course, the fiscal slippage.
That possible normalization of monetary policy stance in developed countries, a spike in inflation is almost a given. On the economy, the RBI paints a rosy picture for the coming fiscal, pegging growth at 7.2%, a tad below the budget target of 7.5%. Consumer inflation in the 4th quarter has been pegged at 5.1%, while FY19 CPI is seen at 5.1% to 5.6% range. Economists believe that the RBI's commentary that liquidity in the system continues to remain surplus may well be a pointer to a shift in monetary policy stance and possible rate hikes going forward. The big debate on the RBI policy and the state of the economy is what we're doing tonight on the India Development Debate. That's the first debate tonight. Joining us on the show this evening, KK Mistry, Vice Chairman and Chief Executive Officer of HDFC, R. Gandhi, former Deputy Governor of RBI, Anant Narayan, money market expert, and Maithili Busturmat, Consulting Editor of ET Now. Let me start with you, Mr. Mistry. How do you read the monetary policy statement? The Monetary Policy Committee notes in its statement that inflation outlook is clouded by several uncertainties on the upside. Fiscal slippage, MSP revision, Supriya pointed a few of them as well. How do you read the statement of the MPC?
See, I think first of all, the policy is absolutely in line with what we expected. We did not expect any change in interest rates, and we did not even expect any change in the stance. I think the more important thing that we were looking for in the policy is what the governor would talk in terms of infusing liquidity in the system. As far as the inflationary outlook is concerned, I think even that is pretty much taken for granted, was known, in the sense that we knew about the minimum support price for food, we knew about oil prices and the risks that that sort of entails. So we were aware of all the risks. So in that sense, the policy is pretty much in line, or I would say almost exactly in line with what we would have expected.
Okay, let me take this across to Mr. R. Gandhi, who is joining us also right here on India Development Debate. And Mr. Gandhi, are you surprised that given the 6 big reasons that have been outlined which will stoke inflation even further, the RBI has chosen to maintain its stance neutral and not turn hawkish? I mean, it's not just inflation that is likely to go up and will go up to levels of 5.1 to 5.6% in the first half of next fiscal. It's also fiscal slippage, and the governor did make a very sound mention of not just this year but for the next 3 years. So are you surprised that the stance continues to be neutral?
I don't feel that we need to be surprised about not changing the stance from neutral to what's that, a deficit or whatever. That is not the issue, because as you can see from the policy statement and the fan chart that is displayed there, that over the period of the next year, over the several quarters or months, the inflation is expected to be coming down, even though at the higher level 5.1 to 5.7 or 5.6 whatever they have mentioned, but by month or quarter by quarter, that the fan chart shows that the inflation is likely to trend down. So that is based on the known risk that is already there for the inflation. So that is why I don't think that they need the stance to be changed from neutral. There is not enough factors which will compel the Reserve Bank to change the stance.
Comment on that, the RBI is sort of, in a wait and watch mode when it comes to the impact of the MSP revision on inflation, and the street also seems to be divided on the extent to which it could stoke prices. There is a view that the impact will be minimal. You have some economists say that it could be only 10 to 15 basis points impact on inflation, whereas others are worried that on specific agri-commodities like paddy, you could see a more significant impact on inflation, on food price inflation. What's your own assessment, and do you think the RBI is RBI's position is sort of more nuanced? Does it make sense to have a more wait-and-watch approach and not panic on account of the MSP revision impact on inflation? Maithili?
Well, yes, I would think so, for the simple reason that as far as the SPE increase is concerned, yes, the government has promised an increase of 50% over cost, but the fact is that we don't have the mechanism in place to ensure that public procurement really happens on the scale to which the government has promised. So to that extent, I'm not very sure that the government will be able to translate that promise into action on the ground. Also, as Mr. Gandhi mentioned, there are a number of uncertainties. So even though theoretically one could perhaps argue that there was a case to shift towards a more hawkish stance, particularly given the fact that the trajectory of interest rate hikes in the US is not known, the fact is that the RBI perhaps will want to maintain that neutral stance also for another reason. It has a job as a debt manager of the government. And if the government's interest rates for its borrowing goes up dramatically, this could make life very difficult for the government. So while the RBI wants to maintain its independence and to that extent is not willing to kowtow to the government and cut interest rates or do anything that would kind of in any way impinge on its autonomy or on its fight against inflation, to the extent that uncertainties in the future could justify its maintaining that neutral stance, to the extent that it might help yields, because remember, yields have been going up phenomenally over the past few months. I think right now wait and watch seems to be a right approach. We'll have to wait and see how things pan out in the future depending on what the Fed's action is.
Okay, depending on what the Fed's action is, we'll just speak about Fed in a while from now. But I do want to talk about fiscal slippage. And Anand Narayan, I'm going to come to you on this. On fiscal deficit, when the governor was asked a question, he didn't just talk about fiscal deficit at 3.5% for this year. He spoke about fiscal deficit at 3.3%. He in fact went on to say that we will eventually meet 3% at the end of fiscal year 21. So it's obviously playing on the mind of, policy makers on Mint Street. The fact that the government is going to miss its fiscal deficit target next year, it's going to be relaxed for next year and this year, given the fact that RBI in 2014-15 had very categorically said that fiscal deficit will be one of the major constituents of monetary policy. Are you surprised that fiscal deficit doesn't seem to be a constituent anymore, despite fiscal slippage that the governor spoke about? He justified it by saying that it's the fiscal consolidation trajectory that we are now looking at. And which is why people are questioning that, which is why people are wondering, will he go hawkish, but he continues to be neutral. Are you surprised, Anand?
No, not really, Supriya. I think, look, he did point out that the macros have deteriorated substantially since the last time that the MPC met. So he mentioned fiscal policy, he mentioned the fact that oil prices are higher, he mentioned the fact that inflation trajectory is uncertain, he mentioned the fact that the global environment is looking very different from what it was 2 months ago. Now, the reason probably why he didn't have to go to a hawkish stance or actually do a rate hike is because, as Maithili pointed out, the market has done the job for him. Since the last policy in December to now, market yields have gone up by more than 50 basis points, 60 basis points in some cases. So when the market is not expecting a rate hike, is not expecting a change to a hawkish stance, and yet has moved up by 50, 60 basis points, why would the RBI want to waste its energy and its bullets and actually affect a rate hike or a monetary policy stance going forward? So I think the market has taken care of the job for RBI, and therefore there was no additional requirement from the RBI. The other thing which I frankly took heart from was the projections given by RBI on inflation, as Mr. Mistry also mentioned, are frankly in line with market expectations and on the higher side. 5.1% average for this quarter, 5.1% to 5.6% for H1 of next year, and 4.5 to 4.6% for H2 of next year. All of these are well above the 4% mark that was otherwise the watermark for RBI. And it seems as if they're going to look through short-term spikes in inflation, which means that we might actually not get a rate hike if the base case plays out. And I think base case is going to be well within these inflation ranges.
Indeed. Okay, so now let's look at the next sort of move, so to say. Mr. Mistry, what's your sense on the next rate action? Is it a given that the next rate action obviously is going to be a hike? And do you expect the central bank to raise rates at any stage in 2018? When do you see it coming?
2018 is frankly a long way to go. We are talking of the next 10 months, and it's very difficult to take a call beyond the next 2 or 3 months. So in February, we did not expect a rate hike to take place. I think by the time we come to April, the next credit policy, I think RBI will be very watchful of data. by which time we'll have a much greater sense of where US is headed in terms of interest rates. Generally the trend is upwards, but how much upwards, RBI will have a better sense. Oil prices, there will be probably greater data to indicate where oil prices are headed. Monsoon outlook seems benign at this point of time, seems good at this point of time. Maybe RBI may have some better data by that point, by that time. So I think it's very difficult to take a call beyond the next month or two. So 2018, yes, in my view, it is possible that RBI could look at a rate hike. Would it happen in as early as April or May, or would it happen sometime in June, July? Difficult to say. My sense is it's unlikely to happen in April, May. It's more likely to happen in the second half of the year.
Mr. Gandhi, given the fact that the RBI policy statement itself talks about these 6 factors, and the 6th factor that it underlines very clearly is normalization of monetary policy in developed economies, and how that's going to be a cause of concern and could affect investor behavior. Given that, you know, global central bankers in coordination are now going to go in for tightening, how much more time before the RBI follows suit as well? And if it does, how many rate hikes are you anticipating in calendar year 2018?
Global central bankers' action, the thing that is different from inflation management within India. To what extent the global factors play out on the foreign exchange related issues, the cash flows, the inflows and outflows of foreign exchange, that may determine certain aspects of the monetary policy, but that will be factored in by the MPC in their next meeting, and that's why the MPC meets once in 2 months to take quick stock of the various developments, including whatever happened elsewhere. That will be a factor, but that won't be a determining factor or the last factor on which the decision on the monetary policy will be taken. Monetary policy will be more focused on domestic inflation and the growth prospects relating to that. So that is what I don't think that international ramifications or international decisions on monetary policy in elsewhere that won't be the determining factor. Let me put it that way.
Maitri, come in on that. Important to note here that there was one member of the MPC who voted in favor of a 25 basis point hike, and that was Deputy Governor Michael Patra. So you have already, one member of the MPC, making a case for a rate hike. And again, rates right now, repo rates in India are at the lowest since 2010. So much as industry may want more accommodative policy, is it clear that we are at the end of the monetary easing cycle and rates will turn the other way? By how much do you expect rates to go up in this calendar year?
Very difficult really to outguess the future, Sandeep, but yes, Michael Patra is always known to be a hawk, and he's always taken a much more hawkish stance than the other members of the MPC. So I do think interest rates will go up precisely because all over the world central banks are on a tightening cycle, and even though, as Gandhi mentioned, that domestic factors will count for more in India, particularly because food is a very large constituent of the consumer price inflation, the fact is that India alone cannot follow a different path from the rest of the world, because if the US hikes rates, there will be an outflow of capital from India in search of safe havens, and that has implications particularly for forex rates. And if the rupee again depreciates, we want it to depreciate, but if it were to depreciate too much, then we'll find oil prices increase dramatically, not only because global prices are rising, but also because of the depreciation effect of the rupee. So I think overall inflation in India is likely to go up, and the RBI will have no option but to hike rates. Maybe if not once, at least I think twice, perhaps even thrice is my expectation in this year, because going forward, the government is likely to loosen its purse strings a bit. Remember, it is a pre-election year. So overall, I do expect interest rates to go up. If not in April, definitely by the time of the next monetary policy meeting.
All right, they've resisted temptation this once. Wonder whether they'll be able to do it for long, is the word coming in from Maithili. But I'll really turn focus and talk about growth right now. And one of the things that the RBI commentary very specifically speaks about, Anant, is that its outlook on growth, GVA at 7.2% for the next fiscal versus 6.6% for this fiscal. It has very clearly pointed out that GST stabilization is going to be a big growth driver. It also believes PSU bank recap will be a big growth driver, so will be the cleanup via the IBC route. The question really is that the RBI policy talks about improved credit offtake, and early signs of improved credit offtake. I think the governor in his commentary even mentioned a double-digit growth that we are seeing. But is this what is really going to drive investment is my question, because, and is it time we differentiate between investment in greenfield projects versus investments in working capital and, the kinds that PE and VC firms see? And that is really going to be the big differentiator, because real investment is investment in greenfield projects, and I'm not so sure if that's still happening, and is that what the RBI is referring to? Anand?
Oh, absolutely, Supriya. I think you hit the nail on the head. In fact, on a side note, the fact that our budget increased our revenue deficit from 1.9% of GDP to 2.6% of GDP belies this entire thesis that we should be allowed to, loosen our purse strings on the fiscal side as long as it's going into productive investments, which it clearly doesn't seem to be doing so. But when it comes to the GVA estimates, the one number which I found incongruous was the 6.6% for this fiscal. Clearly, it's at a huge variance from the number given out by the CSO, or even the number given out by the finance minister on the budget day. The next year's number seems a lot more doable. I do think we will see in FY19 a pickup in growth, and it's a reasonable expectation to have. The stumbling blocks and the teething issues that we had with GST will hopefully be behind us. We do see an activity, if you look at the fast moving data coming out, including PMI, including IIP, including quarterly results, albeit it's on the back of a very low base effect from the last year. The numbers are clearly picking up at a micro level. So that bodes well for going into FY19. I do think the growth numbers for FY19 will be reachable. That of course puts a double whammy, because if growth does pick up and credit offtake does pick up, that could in turn put pressure on inflation, and it will put the whole monetary policy into test. But the growth expectations for next year seem doable. They are within our reach, with the caveat, of course, that there are lots of risks, both domestic as well as external, that one has to worry about, including the global environment. And let's not forget, this is an election year with elections of the end of the year. So, lots to watch out for.
Indeed. KK Misri, comment on that, on growth really. The RBI in its commentary today has pointed out that bank recap and IBC resolutions will further improve credit flows, and that will create demand for fresh investment. Do you see that happening realistically, and by when do you see that happening?
I do see that happening. I mean, if you look at the micro data that has been emerging over the last 2 or 3 months, or maybe a little more than that, you see that the micro data is beginning to start looking better and better. The credit offtake is beginning to happen in the system. We in our business, in housing finance, for example, for the last several months have been seeing some pickup in the demand for housing loans. So credit offtake is happening, capital investments are beginning to happen. I'm not saying they're happening in any significant manner, but at least they're beginning to happen in the system. The IIP data numbers are beginning to look better. So given all of that, I would expect the growth outlook for next year to be much better. Also, we must bear in mind that we've had 5 big reforms that have happened in the last 12 to 13 months or 14 months, starting with demonetization, GST, the Real Estate Regulatory Act, the insolvency proceedings, and the recapitalization of the public sector banks. So now the multiple effect of these 5 reforms should happen over the next 6 to 12 months. So I would expect that to translate into higher growth numbers.
All right, Mr. Gandhi, there really is many a slip between the cup and the lip as far as growth is concerned, and the assumptions of the RBI also hinge upon the fact that GST will stabilize, also hinge upon the fact that PSU bank recapitalization will ensure greater credit offtake, hinge upon the fact that IBC will resolve the bad assets. So there are obviously many ifs before growth does fructify. My question to you really is, do you see investments take off? Because one of the things that the governor said very clearly, and I think he kind of indicated what corporate India has been saying for a while, that there are 5 kind of taxes even on capital. So even on capital, which is a big constituent of growth and will ensure that growth happens, he did say the kind of taxation on capital is big, and that hinders investment to GDP. He said there is DDT, there is corporate tax, there is that over 10% tax. So he's really making a case for capital, taxation on capital to be lowered, and which will aid growth. Do you agree with that at all? Do you believe that's an issue as far as raising capital and investments is concerned?
Yeah, capital raising and capital investment and credit towards capital investment and other thing, it is a different one, distant. It is not going to happen so soon. That's my view. In the sense that green projects, we are not seeing any big announcements made. So the credit flow that has picked up in recent past and the coming months expected also will be more towards working capital and retail credit, because that is what is happening. So naturally, for capital formation, any amount of fiscal support in the form of tax concessions or a different way of dealing with the capital gains and other thing will certainly be helpful.
Okay, let's talk about the bond markets. Anant, are you disappointed that there was not too much focus from the central bank on the action in the bond markets, especially given the way yields have moved? If not open market operations, the street was expecting open mouth operations, but none of them coming through.
Well, Sandeep, the bond market seemed happy with the policy today. Bond yields came off by some 4-5 basis points today. So I guess they are happy with the fact that we don't seem to be having rate hikes coming up in a hurry right now. But, it's not really the remit of the MPC to address what's been a technical issue in respect of bond market participation. And you're absolutely right. The elephant in the room is that for the last month and a half, we've not really seen a fully liquid market. We've seen too many auctions getting cancelled. We've seen very little of actual activity in the secondary market. And we saw a month in January when yields went up quite sharply. And public sector banks, one of the largest participants of the bond market, who typically buy bonds when yields go up sharply, actually were selling bonds in the secondary market. So clearly there is a technical issue which needs to be resolved. We need RBI, the government and bank participants to come together and try and figure out a way forward. We still have time, by the way, because there's not much of borrowing the government needs to do between now and March end. But come April, and when the new fiscal program starts and the new borrowing program starts, there's a whole host of auctions which will need to go through, both from center and from the state. And we can't have this ambivalent stage continue forever. So between now and March, I do hope that people come together and some sanity returns. And once that happens, then we have to address the bigger issues of how the demand-supply mismatch, which appears to be there for bonds as a whole across state and central government bonds, get resolved going forward. Do we start to look at increasing FPI limits, or do we hope that actual retail investments will start moving towards income funds and gilt funds and therefore produce some more demand? Because as things stand, there is a mismatch. There is a prospect of more supply than actual demand that exists in the system.
I couldn't agree with you more on the fact that there has to be a supply-demand mismatch. But Maitri, I think Anand is really pointing me out to a question that we were discussing earlier in the day when we were covering policy, which is, what is the indication from the RBI on how is it going to assist and help the government on its borrowing program? Like Anand pointed out there, public sector banks have very low appetite. You were talking about liquidity surplus, but if you actually look at credit offtake happening, then liquidity will be in short supply, so there will be a liquidity crunch. Where does that supply-demand gap in the bond market get where does the confluence really happen? And without which the government's borrowing program will not take off. So what is the sense you're getting from the RBI? Or do you believe Veeracharya said a lot more than he intended to when he made that statement about asset classes?
Oh, well, yes, I think Veeracharya, I don't know whether it was a slip of the tongue or it was deliberate when he clearly said that the liquidity management of the Reserve Bank of India would not be directed to having the, determining the price of any particular asset class. And here he clearly indicated, I think what he had in mind was a bond price. Now that I'm not very sure is what the RBI, a government would be happy to hear, and this might open up a new front. On inflation, the government and the RBI are now more or less on the same side. The earlier kind of controversy that we saw is no longer there. On inflation also, government seems to go along with the RBI, if not very happily, not very unhappily either. They seem to be supporting the Reserve Bank of India. But on the government borrowing front, if the RBI is not going to lend any support, I think then government will be in serious trouble. Because even though the net borrowing may not be larger than last time, the gross borrowing target is more than it was last time. And if credit offtake is going to increase, you're really going to find the banks strapped for funds, particularly because if you see, deposit flow has not been very good, because thanks to the fall in interest rates, many retail savers have moved to the equity market. It's a different matter that the equity markets are now falling and some people might return to the banks. But overall, I think it's going to be a tough call to manage demand and supply. One easy option which Anant was hinting at is that perhaps, that the government might be tempted to raise the inflation limit for FPIs. But that would be a very wrong way to go, because if you raise the FPI limit, you'll find much more dollars coming in purely based on arbitrage facilities, and that would further keep the rupee up. So I do hope the government does not succumb to the temptation of opening up the floodgates through FPIs anymore.
Indeed. Okay, just got time for two quick closing comments, and first one from you, Mr. Gandhi, which is on this whole crisis of confidence. What's from the point that Anant made and Maithili alluded to as well. There seems to be a crisis of confidence between the central bank and the bond market. What can the RBI now do? Anant is right that probably it's not the remit of the monetary policy framework to intervene and calm the bond markets. But what really can the central bank do to address the issue right now?
I don't think there is a discordant note between the Reserve Bank and the market participants' expectation. That is about what the Deputy Governor had earlier talked about is the futuristic way in future how the bond market and the market participants should be playing. So I do not think that there will be a discordant in terms of understanding the requirements of the economy, either from the central bank or from the market participants. I don't think that should be an issue.
All right, let's quickly get in a last word from KK Mistry on this. And Mr. Mistry, what about the bond markets? I think the question that Sandeep wanted to get a big headline out of Mr. Gandhi was, are you disappointed that the central bank has done nothing to stem the chaos in the bond markets, with yields shooting by 80 basis points since July? I mean, even the commentary or the statement obviously had no direct, direct commentary on the bond markets or the market chaos and all of that. I understand it's not in the realm of the Monetary Policy Committee, but just to go back to my question, are you disappointed that not enough communication was done to perhaps stem the chaos?
See, when we do a comparison like this, we do a comparison with the immediate preceding 6 months or 8 months when the numbers look very drastic, when you see that yields have gone up by 70, 80 basis points. But if we go back to July of 2016 and compare yields with what was prevalent in July 2016, compared to that, things are not so bad. The cost of borrowing money in July 2016 was higher than the cost of borrowing money today. So if you compare it with the immediate past, if you compare it with the past 12 months, then yes, the yields look extremely high. But if you go back to, let's say, 18 or 20 months, then yields don't look so bad. Having said that, I would have liked to see a little more in terms of infusion of liquidity in the system. Something of that sort being mentioned in the RBI policy. But I'm sure action will follow once RBI senses how the bond yields are reacting in the market.
All right, so we're all keeping our fingers crossed as far as liquidity infusion action to follow from the RBI. But thank you very, very much, KK Mistry, Maithili Pastore, Mr. R. Gandhi and Anand Narayan for being with us in this edition of the India Development Debate. This was a monetary policy that was being watched like a hawk, whether it will turn hawkish or not, but they've decided to stay neutral and they've decided to not cut rates. Inflation, however, is paramount. The commitment has been reiterated to contain it at 4%, plus minus 2% here and there, and the upside risks to inflation are many because the mitigating factors really dwarf in comparison to all of that. We'll of course keep a very close eye on monetary management and fiscal policy right here on ET Now.
Indeed, on that note, we'll slip into a short break here, but don't go anywhere. On the other side is the second debate tonight on this special edition of the India Development Debate. We put the spotlight on the Prime Minister's speech at the Parliament. He sounded the poll bugle as an indication, and we'll also talk about the quality of discourse at Indian Parliament. All of that and more. It's a fiery political debate coming up in just a few minutes on ET Now. Keep it with India Development Debate.